So we've seen that increasing money supply leads to increasing price levels or inflation. What about the costs of inflation? And here at first, we'll focus on low to moderate levels of inflation and talk about some of the costs for society. And you'll see as we go through that these costs are relatively minor. And in general, economists think that low or moderate levels of inflation, 2%, 5%, 8%, 12% per year, it's not that big of a deal and may be healthy for the economy to keep the economy expanding. All right, so the first one we have here is shoe leather costs, and this is an older term that comes from before we had online banking. And if you think that we are going to have inflation, in other words, the value of your dollar is decreasing over time, you may want to keep your money in an interest-bearing account rather than holding cash, right? Because the value of your cash is going to be decreasing over time. So this may cause you to shift more of your assets to interest-bearing accounts and only take them out more frequently as you need to spend them rather than just holding cash. So say instead of having in your wallet enough cash to last the whole month, you have only enough cash to last the next week, and then you'll go to the bank and take out money when you run out, right, for the next week. So the cost here, what is the cost? The cost is just an increased number of transactions, right? So this shoe leather cost term comes from the time when you had to walk to the bank to get money out, right? And you might wear out your shoes more often from an increased number of trips to the bank, okay? So more shifting money from interest-bearing accounts, I don't know how to spell that, to cash, right, to currency or the form you're going to spend it, okay, maybe your checking account. All right, the next one is menu costs, and this really just comes from businesses having to change their prices, right? So if we imagine that the value of the dollar is decreasing, right, prices are going to go up, and it's going to be costly for businesses to reevaluate their prices and reprint their menus to show the new price level. And the third one is tax distortions. So our tax laws are all written in nominal terms. So we have tax brackets. We've talked about this before. We have tax brackets that say this is your tax rate if you fall into this income category. But those categories are all in nominal dollars. So when we have inflation, right, the value of a dollar goes down, prices go up, your income goes up. It's going to push you into a higher tax bracket, right? So here we have inflation as taxation, right, without any conscious decision to increase taxation, people will be pushed into higher tax brackets. All right, so the next one is confusion or relative price variability. So we may have businesses shifting their prices up at different points in time, which distorts like how we use prices to compare value of different goods, right? You might say, oh, the price of apples has gone up, but the price of oranges has not. And then the next week, the price of oranges goes up as well. And this might distort consumer decisions about which product to buy. Not based on actual cost of production, but just based on these relative price variability, the relative prices of those products changing at different times. People can also just get confused, right? Like I go to the store and I see the price of this product is higher all of a sudden. I don't know if that's because the cost of producing it went up or there was inflation and I might not buy that product, even though really the price of all products is rising. Okay, so this might distort consumption decisions. But you'll see, right? I hope that you see as we go through these, that these are all fairly minor costs, right? So we might have to reprint our menus twice a year instead of once a year, or every month instead of every 2 months, right? This is a relatively small cost in the grand scheme of things. And then we have the last one would come only with unexpected inflation. So part of the job of the Federal Reserve is not to just prevent all inflation, but to make sure that we have some stable level of inflation, that we all kind of know what to expect. We don't want a lot of unexpected inflation, or on the high end or on the low end, right? We don't necessarily want unexpected deflation either. We want to have a fairly stable value of currency over time, not necessarily in terms of it's always worth the same amount, but perhaps that the value of our currency is decreasing, or price levels are increasing at kind of a stable amount over time. So this happens when we have unexpected either inflation or deflation. Or I could say that the inflation rate is higher or lower than expected. And basically what's happening here is that we make all of our contracts for lending and borrowing based on what we expect the value of money to be over the course of that contract. So say you're going to buy a car, you take out a loan, you have an interest rate in your contract. That interest rate is written in nominal terms. So when you pay back your car loan, you pay back some set amount of money in nominal terms, right, every month for the next 5 years. Well, if we have unexpectedly high inflation, the value of the money you're paying back over the 5-year period is going to be decreasing in real terms, right? So this leads to distortions in the financial market, right? Where, in the loanable funds markets, where you have a transfer of wealth either from borrowers to savers or from savers to borrowers, depending on whether or not the inflation rate was higher or lower than what we expected it to be when we wrote the contract, okay? I'm gonna have you guys watch another short video about this just to kind of hammer this home, and also to show you, right, the difference between what we mean by nominal interest rates and real interest rates. All right, so go watch the video on the real interest rate and how inflation affects transactions between borrowers and lenders in the loanable funds market, and then we'll come back for one last concept. We'll talk about hyperinflation, which, unlike these low moderate levels, which don't seem that bad, hyperinflation is a huge economic problem that will really lead to the collapse of an entire currency.